I can never figure out how to do this. I literally can never figure out how to get the I never forgot how to get the freaking URL. All right, there we go. Now we got it. Bet. I need music. Ugh. What a day, man. What a day. What a day. What a day. All right, so today, guys, we are going over some of the best options to trade, because the issue that I saw today in the chat and with some of the other people are that they're trying to trade options. They don't understand what options are, but they're trying to get into because they hear everybody talking about how cool options are. So they've been reading, but they still don't quite understand, because options isn't something that you can do if you still have and I don't want to sound like I'm being judgmental or anything, but options isn't something that you can do if you are in a penny trader or penny stock mindset. It doesn't work that way. So today I want to talk about some of the best stocks to day trade with options, as well as some of the best ways to play options to minimize your risk and still enjoy and have fun with it. Okay. So if you guys are in the chat right now on Facebook and you would like to come over and ask me questions about anything I'm talking about, please feel free to click that "What are options? Best options to trade" link, the YouTube link. We are live on YouTube right now. That's just the best way to communicate with me and ask me questions, because Facebook, as always, is a hater. Okay. So here we go. We're talking about options again, because I'm trying to nail this into your head. All right. The way that options work there are two ways to trade options. And you guys know I'm going into Photoshop. So let me find my pen real quick. I lost my pen already. Where's my pen? All right, it doesn't matter. Oh, there it goes. Okay. So there's two major ways that you can trade options, okay? And the way that you guys have been seeing it done mostly is the more, I would say, advanced way. So let's go over the basics of how to set up your account for options. There are 4 different levels of options. One, you can pretty much write covered calls. So covered. 2, you can purchase, so you can buy options. Bro, my O looks like a D right now. What is going on with my pad? And then 3, you can write contracts. And 4, I don't even want to talk about 4. Like 4 is like a no-no's land. You want to at least get to 3. Okay, that's your goal. You want to at least get here. And let's talk about why they're split up, the way that they're split up, okay? The reason why most brokers split down options into covered calls, buy options, and being able to write contracts is because of risk level. The risk that you need here is very low to the trader. So every brokerage account, and I don't know if they do this legally or if it's like something that they have to do, but they're trying to help you manage your risk, because options, as you guys have saw, can put you into a major hole. Okay. If you don't know what you're doing, it allows you to risk a lot of money. With the double-edged sword, as you can make a lot of money. So every level up is a higher level of risk that you're acquiring and that your brokerage account is trying to make sure you completely understand what you're doing. So level 1, we'll talk about that first. With level 1, what you're going to get here is a buy to close. So there's a U right here somewhere. Buy to close. And then a sell to open, right? When I first saw this, I had no idea what it meant. And some of you guys may be seeing this and you don't understand what that means. And I'll explain it to you. What buy to open means, or buy to close means, and sell to open means that you're going to do a 2-part trade. You're going to have pretty much an underlying asset and you're trying to sell that underlying asset because you're trying to pretty much sell that underlying asset to either make money on the up or the down swing. And let's see if we can. Okay, we can't. So let's do this real quick. Bro, they always hate on me. Photoshop always hates on me when I get online. We want to do the paint bucket. All right, here we go. So let's talk about level 1 here. So this will be level 1 for options. Level 1. Open to close. What this means is you already have at least 100 shares of a stock. So let's just say Apple. Right? So you own 100 shares of Apple. Right now it's sitting at, let's just say $345 a share. You believe that Apple is going to drop all the way down to maybe, let's just say $300 a share, right? So you think Apple is going to drop to $300 a share by, let's say, October. You think it's coming in October. You're going to write on level 1, a level 1 option, a buy to close. What you're going to do is you're going to write a contract here. So in between here with a open sell to close or open to close here. And what this pretty much means is, hey, I own 100 shares of Apple, right? But I believe that by October is going to drop to $300. I want to still be able to sell at $345. And then the way you close this position off, the way you close your contract off is you sell the contract to open. This will be a sell to open, meaning that you're creating the contract, you're selling the contract to open, and then you close it by open to close. So I'm going to sell a contract or a premium on a contract for the 345s. And now if it comes down to the 300 price, I'm going to close it with the open to close by exercising the contract and selling it at 345 and collecting my premium and my shares. That makes sense? Probably not the first time around. My premium and my shares. So if you guys are trying to ask questions, make sure you come over to the YouTube. I'll say that every time, but make sure you come over to the YouTube, all right? Let's do it one more time. Basically what you're doing is securing yourself. And the reason why it's not risky is because you already own the shares. So all you can do at level 1, all you can do with this level 1 right here is pretty much write contracts for underlying assets that you already own. So ETFs or stocks. If you own 100 shares, you can write a contract for it and you can protect yourself from it going up or down. And all you're pretty much doing is paying out and selling the premium. It's no risk to the broker. And that's why it's the very lowest level of the actual, option level chain. I own shares. I want to either sell them at a higher price or let somebody else buy them from me because I think I made all my money. I'm going to dump them off to somebody else. So pretty much you're writing a contract and you're backing them up by something that you already own. I'm trying to think of a really good way to explain it. outside of options. So I guess the way I would explain it is, if I own a house and I already own that house, right? And I think that the housing market is going to crash, I may do a sell to open option to be able to sell my house at the highest evaluation, even though the market crashed, and I'm backing myself up by that contract. Now, if the market doesn't crash and it goes up, then I just lose the premium that I paid on that contract, because I'm not going to exercise my right, and I'm not going to sell my house because my house retained its value. That's the same thing as it's the same thing with stocks. Now, the second thing is to be able to buy the options. Now, that's nothing too major. That's literally just gives you the ability to say, hey, there's an option out here for Apple at $300. I think Apple's going to go up to $340. Somebody's already wrote the contract. I'm going to buy that contract. That's all it is. It gives you the ability to actually buy a contract. The reason why this is level 2 is because, again, there's no real risk to the broker, because you're going to back it up by having the money to buy the option. But at the same time, 90% of options expire worthless. So this is also not a really good strategy. Okay. This is a decent strategy. This strategy sucks. Actually buying contracts is a really bad strategy, because 80% or 90% expire worthless. Some of them do go in the money, but most of them, like contracts, they're kind of tough. So a lot of them do expire worthless. So it's a lot of risk to the actual buyer. Now, number 3 is where everyone is at, pretty much. Level 3 is what you need to write contract. You want to be able to write and sell contracts, pretty much. Okay. So level 3 is the most, I wouldn't say risky, but it's pretty risky. Level 4 doesn't give you too much different than level 3 does. One sec. Level 4 doesn't give you too much of a difference than level 3, but level 4 is where pretty much everyone who buys and sells is at. So let's do this, and then let's fill this in with white and not green. Basically what happens on level 3 is that I can now write contracts, meaning I can write the promises to other people if they want to buy them from me. So I can pretty much go in and say, I'm going to write one contract or 2 contracts. Let's just say 2 contracts, which is 200 shares, right? I can write one contract, which is 200 shares. And what I'm going to do is, in order to write this contract, I'm going to pay a premium, or the price of the contract. So let's just say this contract is $2 a contract. And you can find that for like Apple. We can find Apple contracts for $2. So we'll just say Apple here. So that means what I'm going to do is do 200 times 2. The reason I'm doing 200 times 2 is because the price of the contract is $2 per contract. I have 2 contracts, and one contract is worth 100 shares. So 2 contracts is worth 200 shares. So that's where you get 200 times 2. Okay. So we know that it's going to be $400. This 400 is now my premium. That's the most I can lose. You can only do this on level 3. Okay. So I am writing a contract with a premium that's worth $400 at the time. Now, what most people are doing is saying, if from where I purchase Apple and it goes up, this premium is probably going to go up. So now let's say the premium here was $2. The premium up here might be $4, because now Apple is more expensive. So if Apple is $345 here, but it's let's say $80 here, and I have a strike price for maybe like $400. I have a $400 strike price. This is really close to $400. So now that $2 just doubled to $4 per contract. So the next person that wants to buy an Apple contract, so let's say this is just John. So this is me, and this is John, right? When John comes in, he's going to buy the same 2 contracts, but instead of at $2, he's going to buy them here. And now his premium is $4. Okay, same 200 contracts, so he still has 200 shares, but now it's 200 times 4, which is going to give us what? $800. So now John has the same contract I have, but I paid $200 because I got in early. I mean, I paid $400 because I got in early when Apple was at $345. Apple goes up to $380. John gets in late, and John now has to pay $800 because he's late to the party. But we both still think Apple's going to go up, and it may go up here, and we both may get out at like when we both may get out at $390. John may end up making, let's say, it may go up to $1,000. John may make $200, right? But I wrote it from 4 all the way up to $1,000. I may make 6. What people are selling is this: premiums. This is what you sell. As the stock goes up, the cost per contract goes up. As the stock goes down for calls, the cost per contract goes down. What we're doing is selling these contracts like people sell stocks. Okay? Any questions? Okay, no questions. Now let's talk about the best type of stocks to do this with, okay? So I'm going to do a new layer. Fix it with white. Now, since we know that what people are actually doing, since we know what people are actually doing, they're not exercising their contracts, right? Because if I was to exercise this contract with Apple instead of $400, I would have had to pay the $400 plus the actual $200 per share of Apple at $380, right? So we're not buying and selling like exercising the contract and then selling. We're not doing that. We're literally selling the premiums. Premium goes up, we sell it. We give our contract to somebody else. Like I could have gave my contract to John. I could have got in at $2. It could have went up to $4. I could have made 100%. And I would say, you know what? I want to sell this contract to somebody else, not the shares of Apple, but just the contract because it hasn't expired yet. I want to sell it to somebody else. And John comes in. John buys my 2 contracts. He pays $800. I get out. I'm done. John rises it up a little bit more, and then he gets out. That's what we're doing. We're selling the premiums on the contract. Okay. Now, with that being said, what are some of the best stocks to actually do this on? The more expensive ones. You don't want to do this on cheaper stocks because cheaper stocks don't have the volatility on their contracts. And what I mean by that is their contracts aren't being traded at the rate of higher contracts are, because a lot of people want to own these companies, right? So a lot of people are buying these more expensive companies. People aren't buying a lot of cheap companies. At least they're not buying them with a mindset to hold them for longer than a couple of minutes to an hour to a day. So those contracts tend not to make as much money. You want to come in and buy the more expensive top dollar stocks. And you don't have, again, we don't have to spend a lot of money. You just have to find the right contracts. So these are my favorite. I'm about to list my favorite companies to buy contracts in, okay? If I can get my pin. So Facebook, Apple, Microsoft, Amazon, the SPY, SPY, and Boeing. These are my stocks that I buy options on. These are the only ones. Oh, crap. Tesla. Tesla's a dope one too, but Tesla's a little scary. Tesla. These are the only stocks that I watch all year, and I make all my money off of these. When I don't know what's going on with maybe Amazon, I'll scratch Amazon and move Tesla in. If I don't know what's going on with the SPY, I may scratch SPY and move Apple in. But I rotate these all year, and this is what you'll see in my portfolio all year. I only buy these contracts, and the reason why I buy these contracts is because of the spread, right? So what you have on a lot of these contracts are the ask, the mid, and the bid. So do we all understand how stocks go up and down in the chat before I get into this? What is the relationship of the premium to the stock price? In other words, if the actual stock price goes up $1, does the premium on the option goes up on $1? So Anointed Pin Ministries, what you're asking about is what we call the Greeks of options, right? So you're asking about delta, theta, about delta, gamma, theta, rho. And yes, it does. But at the same time, premiums go up as much as people are willing to buy. So your premium can go up, and if no one's willing to buy it there, then you're not going to make any money. So that's what we're going to talk about next. But you're absolutely right. There are a relationship between the stock and the actual option. So the first thing I want to know is, should I explain how your ask and bid works and how like level 2 and stuff like that works? So if I pulled up a chart and it looked like this, would you guys understand the bids and the ask? I just want to make sure I give everybody the link. So I don't see any questions about volume and ask and bid in level 2. So I'm going to assume that everyone here that's watching, all 14, 15 of you guys, understand how the ask and the bid works. Okay, so I'm not going to go over that unless somebody asks me a question later on. Okay, so basically, when I look at my contracts, so let's pull up the one that we played today. We played Tesla pretty much all day. There was no need to play anything else. Tesla was the man all day. What I normally look for is how high the implied volatility is. Normally closer to the date of expiration, the volatility is a little bit higher. And further out, it tends to stabilize a little bit more. So I actually played the June 10th, which has about 80. So yeah, it's more or less right. I probably could have played out to the 17th, but I normally don't play. I normally play weeklies. So, for me, that was the one I was comfortable with. I wasn't comfortable with the July 2nds. So I played the June 10th or the July 10th weeklies, and I normally play always out of the money. I know we don't play in the money because they tend to swing a little bit too fast for me and my heart can't take it. I try to minimize my risk by playing out of the money so they don't move as fast. Okay. So the way that these options work is there's a few rules that you need to follow. You always need to use a limit. Always use a limit order. Okay. Always use a limit order. My biggest mistake when I first started trading options was I wasn't using limits. I wasn't using a limit buy, and I wasn't using a trailing loss. So now I use a stop trailing loss, or STL, right? On all of my orders or all of my sales, I use a limit on all of my buys. And this keeps me from losing a lot of money. And I'll explain to you why this happens way more often in options than it does on actual stocks, okay? So I play the 35s, the 1035s, and the 1040s pretty much all day. And you'll see that they went up pretty good today, about $24 today, which is really good. And if we look at this stock, if we look at this one, let's pull it up real quick. All right. So we can see pretty much Today on 6/15, it started off at $33, which is pretty much where I got it at, and it went all the way up to almost $60, so almost $100 move on Tesla. Yeah, pretty much almost $100 move on Tesla. Not $100, 100% from 31, or from 33ish all the way up to about 60. Really, really good profits, right? The way that this works is, you see this volume down here. You see how the volume isn't like, it's not booming like I would say a stock would, but it's still relatively pretty good when I'm trying to buy and sell. I normally can find a buy and a seller inside of Tesla versus if I was inside of a penny stock, because penny stocks don't have people buying and selling their contracts. They may have people buying and selling their stocks. They don't have people buying and selling their contracts, because no one is trying to be in a penny stock for a long period of time. And they also want to be able to get out when they want to get out and not when there is a buyer, right? So I say all that to say, look at the ask and the bid. Right now, they're pretty far off. If I was to pull up a penny stock, it would be even worse than that. So the best part about buying and selling contracts for better companies, so like the Teslas, the Apples, the Facebooks, is that their spreads aren't horrible. If you do a market order, so this one's a really good one, the 1055s. The last was 48.52. We see the bid right now is 48.85, and then the ask is 52. So the issue with this is this probably doesn't have a lot of volume or a ton of volume, right? So this spread is pretty big. This is 47.25 to 52. So I'll do 47 to 52. So you have 47 to 52. That means that there's a seller here at 52. He wants to sell his shares or her shares at $52. But there's no one trying to buy at $52 as of right now, because the ask is at 47. So this is a buyer. So this is what happens when we try to haggle, right? When you try to haggle, you're on Facebook Market or Craigslist, and you're like, hey, look, I want it for 47. And the guy's like, I need at least 52. You're not going to make a deal. There's going to be no deal made because he wants 52, but you don't feel like it until you can get 47. So what may happen is, if we're doing Tesla, right? So let's just say this is Tesla. Let's say Tesla is at $980 here, right? And the bid right now is 52 and the ask is maybe 47. And the bid is at 52 because the guy purchased Tesla at 970 and he purchased at maybe like 51.80. And so he's not going to sell. If he was at 970 and it went up to 980, he's not going to sell for anything lower than 51 because he's going to lose money. So what's happening is there's a war between the ask and the bid, and you have to find somebody willing to either bump up the ask, this has to go up, or this has to come down. So either the seller has to be okay with taking a loss, or something has to happen to the underlying stock price to make this guy bump his price up. So maybe if this goes up, he's more willing to bump up and take the 52. But if it goes down, this guy has to be more willing to come down to the ask, okay? And that's pretty much how volume and ask and bid works. Somebody has to move their limit orders. So these are just limit orders. Somebody has a limit order to sell and somebody has a limit order to buy. So if you were to not use a limit, so if you didn't use a buy limit and you just went market, you would do market at $52 because that's where the market is at right now. So if you had two contracts, you would buy 200 shares of Tesla at 52. And as soon as you bought this, your 200 at 52 would now be 200 at 47. So you would have lost $5 per contract as soon as you purchased. Right? So you're going to lose $1,000 off gate because you didn't use a limit order. Your limit order should probably be mid or lower. Unless it's a tight spread, If it's a little bit tighter, you can go mid or higher. But if it's a big spread like this, if this is like a really big spread, you need to be closer here, because this guy is overvaluing, right? Now, if the stock goes up, then feel free to move your limit up, but don't move your limit up. Don't do market, because this spread is too big, right? You want to find something that if it has a really tight spread. I can't find one now. I can't find one now mainly because it's aftermarket. But if you can find like a really tight spread, a couple cents or something like that, you can do a market order. But when it's that wide, don't do it. So let's look at some. Let's look at, I would say, not really penny stocks, but kind of rapid movers. Okay. What is that? What is that company that is like the Tesla knockoff? NKL or something like that? NKLA? Yeah, okay. So let's look at theirs. I've never looked at their stock before, but I would assume their ask and bid are pretty big. Let's see here. All right. So look how big this spread is, right? The last executed was at 897. So somebody sold at 897. The bid right now is, go away. The bid right now is 590 and the ask is 940. So that's that's almost 100% difference right here. So let's pull up NKLA. I feel like I'm in college again with all this scribbled on my pad. Let's do this. So this is NKLA, right? The ask right now and the bid. The ask is, what is it? What do we say? Oh, 590 and then 940. 590 and then 940. So the ask is 590 and the bid is 940. And the last sold was like $8 and let's just say 35 cents. So that basically means that the people who are trying to buy this contract are valuing it at $5.90 a contract. But the person there's no one willing to sell down there, and they're so far off that if you did market, you would buy here, and then your contract would immediately be worth this, because that's where the price is right now. It would evaluate your contract based off of the ask and not of what you paid for it. So you would immediately would be down almost 100%. So if you spent $2,000 on this contract, as soon as you purchased it, it would be $1,000, and you'd be out 50% off gate because you didn't use a market order. So always use limit orders on your contract purchases if they have wide spreads, and you want to be about mid. Again, if it's this wide and you think you have a chance for it to dip, I'd probably be closer here than I am here. If it's going up and you're really trying to ensure that you get in, go here. Never go here unless the spread is like 10 cents. But if the spread is this wide and you know it's going to go up, here or here, right? If you think it's going to go down a little bit, go here on the ask. That way you're sure that you're not buying at market price. Okay? All right. Now, let's look at volume, and I'll show you why you don't buy penny stocks. What's the penny stock everybody's been talking about? GNUS, I think. This is Genius Brand, right? This is the one that everybody's been buying for. This is the one everybody's been buying as a penny stock. If you want to buy contracts in that, cool. It's gonna be real hard to sell though, right? It's probably gonna be real hard to sell, real hard to buy, which is what you don't want. That you don't want real hard to sell, real hard to buy contracts, because they fluctuate so much. So if I look at these contracts, the ones that are in the money, Unless if you're trying to sell premiums, I'll take that back. If you're trying to sell premiums, this is not the way to go. If you're literally just trying to secure a lower value, then for sure you can buy contracts if you plan on holding this for a long time and you actually plan on exercising the money that you make if you become in the money, okay? So if I was going to try to be an owner of Genius Brands, for sure I'd buy contracts. That had to be the only way, the only way I would get in this company is buying contracts to exercise later on. But if I'm trying to buy and sell premiums, then I wouldn't do it because it's not enough volume. And we can see that by one, it actually has a really good spread of only 15 cents. So that's not bad, but let's go look at the volume. The volume on it actually isn't bad, so I'll take that back. You could technically trade this. It's not horrible. It's really, I lied. It's not that bad. Genius Brands actually has good contracts, so I take that back. I apologize. Now, I probably wouldn't buy or sell these contracts because it looks like they don't move that much based off of the fluctuation in the stock price. Yeah, I mean, you had this one spike here, but I probably wouldn't mess with these. I'd probably leave this alone. I would probably rather just buy the stock and trade the stock if that's what I was going to do. Contracts probably not the way to go. Again, you want to be in those names that I mentioned for contracts earlier. The SPY, the Bowens, the Amazons, the Apples, the Facebook, the Microsofts, mainly because Tesla can swing 40 to 50 points in a day. Right. So if we look at Tesla, Tesla can swing from $9.15 all the way up to almost $1,000. That's $90 almost on the price, and that caused the contracts to go up 100%. So you want to be in very liquid stocks that have good volume on their contracts, that have a lot of options on their contracts, and you can get in and get out and sell the premiums when you're ready. Any questions? If you guys can't type in Facebook, please come over to YouTube. YouTube doesn't discriminate. You can type as many questions as you want in the YouTube. I know Facebook limits you guys. No questions? We don't have any questions about options? As much as you guys, I'm not going to say that. I don't know who's in here. As much as I get messages after videos, that's for the video. I missed something. As much as I get questions about great explanations, thank you, Anointed Pin. I just want to make sure all this stuff makes sense. So now let's look at some what we call lottery tickets, okay? I'm going to show you guys lottery tickets. And this is how a lot of people become millionaires off of options. And it's actually something that I hope that I can one day do myself. And I actually have a play that I'm very excited about, and I hope that it comes to fruition, because if it does, I'm going to be extremely happy, and I promise to make a video about it. This is called a lottery play because you don't invest a lot of money in it, but it has the potential to probably make a ton of money. And the reason why you don't put a lot of money in it, because risk reward, right? If I have an opportunity to make a lot of money, I also have an opportunity to lose a lot of money. And that's just how it goes. So the SPY is one of the best ETFs to buy options for. It just is. It moves rapidly. It goes up and it goes down fast, which is the definition of move rapidly, right? Definitely learning, bro. Much appreciated, bro. Thank you so much. If you guys are new to the YouTube channel, make sure you hit the like button for me. That really helps me out, grow the channel, and make sure you hit that subscribe button if you aren't a subscriber. We have our first video coming very soon. I'm just trying to figure out how to put it in. Like, streams are easy because I can talk to you guys, but videos I have to be very precise. So I'm trying to figure out how to do that for videos, but I definitely have a video coming soon. But SPYs is a really good options. They're really good options. But what a lot of people confuse is, oh, I can't buy options in something like the SPY. Oh my God, it hit 310. Bro, I didn't know it hit 310 in after hours. I'm legit seeing this for the first time on video with you guys. I'm actually pretty hype. I can't lie. I'm pretty hype on that. 310 is nice. All right. Sorry. I got a little distracted. So SPY is dope because you'll see this volume, like 320 all the way down to 299, 295 up to 310. Like, it's just really good. It's very valuable, and a lot of people like the SPY. The issue with beginning options is you're going to think, I can't afford options in the SPY because I can't afford to spend $30,000 if the option expires. Again, we're not letting options expire. We're buying and selling premiums. So long as you don't let the option expire and you sell it before it expires, you won't have to buy it. And a lot of brokers, if you're out of the money by more than 1%, they're not going to execute your trade for you anyway. So there really is no risk besides losing your premium. Now, the premiums are a little bit higher depending on your risk tolerance. The closer you are to in the money, the more money you're going to spend. The further out you are from the money, the least amount of money you are to spend, because it's less likely that you're going to actually hit that number. Now, remember, options are priced by a few different things. How far out of the money you are, in the money you are, will determine your premium price per contract. The time in which it takes for the option to expire, how close you are, how far out you are, will also determine how much your contract is worth. The implied volatility, how much your stock goes up and down, will also dictate the premium on your contract. And the last thing really is, what is it? I'm sorry. We did time, underlying stock movement, implied volatility. And really that's it. I mean, those are the biggest ones. Then you have the Greeks, which are delta, gamma, theta, and rho, which have their own kind of pricing in them. But if you take that into consideration and you think through your trade, you can figure out, how can I get something as valuable as the SPY, which I know more than likely goes up more than it goes down? And we can prove that by just looking at the stock, right? So if I look at the SPY for the past 3 years, 297 in 2019, we can go back. Can I zoom out? Oh, let's zoom out. Let's go 3 years. So we know the SPY goes up more than it goes down. Goes up, came down a little bit. Goes up again, came down a little bit more. In 2018, we were kind of not in a good position in 2018. And then from 2018, it pretty much has done nothing but go up. Look at all these green candles. Green, red. Green, red. Like, it goes up more than it goes down. So if I know that, and I know in the long run the SPY is good, then all I got to do is figure out when to buy when the SPY is bad. When should I actually buy? So let's look at this chart. I know that this is a weak chart. I look at this and I'm like, all right, the SPY normally puts 2 to 3 bad weeks in a time, right? We can go over this chart the last 3 years. This is a weak chart, right? Normally about 2 bad weeks back to back is average, and you'll see maybe 3, besides in March when we had coronavirus hit, all that other stuff. So I can say something like, hey, if I get 2 bad weeks in SPY, I know it's probably a good idea to buy calls. I know it's probably a really good idea to buy calls, because look, 3 bad weeks and then boom, we rip. 2 bad weeks, we rip. 1 bad week, 2 bad weeks, we rip. And we just rip up. And then coronavirus, of course, whatever. So what you can do is go to your options, go to your option chain, go to your trade tab, go to whatever you want, and you can find really good companies like this on down weeks and buy calls for far out. So what we did, me and my friends, last week when we were down and the and the SPY was down here at 295 or 299, 295, we said, hey, we need to buy calls right now. We have to buy calls, and we have to find the cheapest calls that we could possibly buy that makes sense. So we literally just scoured the option chain. We're like, okay, September, August is probably the time frame. That's what we're expecting in the summer. Start of fall is probably going to pick back up in fall. If this is what we're worried about, we're going to have a really good idea with all the vaccines and everything, at least by September. That's what we're thinking. That's our thought process, right? So we went to the August calls because August only had one. We know we didn't want to be in July. This is the end of August, so we felt kind of safe, and we didn't really want to go in September. We didn't want to go in September because that's kind of the fallish. We came in here and we looked at all the in the money options. Right now they're selling for 100, they're selling for 89, they're selling for 76, they're selling for 66, 50s. And the closer they are to in the money, of course, the closer they are to in the money, of course, the cheaper they are. So you find some that are in the money now and they're selling for 12. As they get out of the money, we're still going for 12, 11, 10, 9, 8, 7, 6. And this is still, we're still what, 3 months out? We're still 3 months out. So we came down here, we was like, man, they got some really good calls at 340. These. Or did we find the 345s? I think it was these. We found the 345s. And at the time in which we found them, they were way cheaper than what they are now, right? They were 73 cents. So I brought the SPY. I brought this $300 stock, right? I brought this bad boy down here for 73 cents a share. 73 cents a share. I have 15 contracts, right? So if we do the math, and we can actually do it right now. If we go do the math, and this is the lottery ticket, right? This is the lottery ticket type of trade where you don't spend that much money, but it has the ability to make a lot of money, and you start averaging up. The closer you get to your goal, you start to buy more, average up because you're making so much money off of it. It then just becomes like a money tree. So I got 15 contracts. That's 1,500 shares. My initial purchase price was 79 cents, meaning I spent $1,185 on that. The most I could lose on this stock is $1,185 for the SPY, right? We know, I can look at the chart and just guesstimate that if I'm anywhere in the money or $20, let's just go $20 out. I can go to the contracts. I want the spider. I can go to the contracts in August. And if I'm $20 out, and $20 out right now is 130, 139. I just go like 139. I'm sorry, 239. 239 right now is going for, oh, I'm sorry, not 233. I'm tripping, guys. I'm sorry. Too many numbers. I was about to say it's way too expensive. 339 right now is, jeez, it's 198, right? So 198. If it technically gets to 198, I'll make $1,000 off of this, but I have until August to make $1,000. The likelihood of this getting to getting there is very high. But what happens if it gets past there, right? What happens if it gets maybe $10 out of the money? It's gonna be worth $6 and some change then, right? So we go back here, and now it's $6 and some change. I'm gonna make $7,000. And because it's so cheap, if it's $7 and some change, it's gonna just keep going up so much to the point to where if it even hits a $10 contract, which is very normal for SPY, as you see, like it's very normal for SPY if you're about a couple dollars out to have a $10 contract. I can make 1,000% off of this. And I have 3 months to do it. So if I go to, what are we in? We're in June, right? So if I go to just the July contracts, which are a month out, or if I go a month out and look at things that are $20 out of the money right now. So our $10 out of money, they're going for $2, $3. So that's a lottery ticket. It's when you go find those really cheap contracts, you pay for them and you expect them to eventually rise. But you have the key goal is you have to buy them on down days. You have to buy them on down days and you have to put so much expiration in them that is worth it to you. I'm already up about $400 on this trade, but I'm not taking profits because like I expect the SPY to at least go back up to where it was and hopefully break through that. And if it breaks through if it breaks through the 340 within the next month, I'm for sure gonna make $10,000-$20,000 by August, and I only spent $1,000. So that's the lottery ticket. That's the real way, if you ask me, how to trade options. Day trading options are too stressful. That is the real way. Find cheap calls, figure out when to buy them, make your money. That's how I would do it if I was like a new trader. Any questions? Basic question by CB. I got a friend named CB, but it's actually like C and not C. Basic question. It is always an option to not sell and keep your contract. Yeah. You have 3 things you can do. 3 things. And I'm simplifying this because you have more than 3 things. You have a lot of things that you can do, but you have 3 basic things you can do, right? And for the people wondering who I'm reading these questions from, again, come over to YouTube. You have 3 pretty much things you can do here. You can, 1, exercise your right to your contract. So let's say, and actually have an example of this. This is when you want to exercise. This is when you will want to exercise your contract, CB. Is when your contract becomes less valuable than actually just exercising it. And I know that sounds like a 5-head kind of explanation, but that's when you would do it, right? When your actual contract is less expensive than actually just purchasing the stocks. Explanation. So hold up. Let me do one thing. All right. So let's go through an example of when I would exercise my contract versus sell the premium. I have 2 contracts, and these 2 contracts premium was worth, let's just say, for example, like $10 a shit. So I would do 200 times 10, which will leave me at what? 2,000. Right? No. 20. Sorry. 20,000, right? So basically what I'm going to do is, that's a really bad example. Hold up. That's not a good example, guys. My fault. My fault. Hold up. Let's do a better example. It's hard when you don't have these examples like nailed out. Hold up. All right. Here's a better example. I have 1 contract right? And the price of this one contract is, let's just say $3 per contract. So I'm going to do 100 times 3, which is going to give me a $300 premium. So $300 premium, right? Okay, so let's say the underlying asset is $10. So now that means that, and I have a strike price and my strike price is $12. Okay, so this is the math that you have to perform to figure out when to actually buy the contract versus when to sell the premium. So I have a strike price of $12. And if I exercise my contract, I have to spend this 12 times 300 plus my premium, right? So 12 times 300 is 3600, right? Plus my premium. So that means that I'm going to spend $3,900 to purchase these 100 shares. Okay. That's my break even. So I'm $300 in the hole if I buy at 12 because of my premium. So now I need to be $300. I need to at least go up higher than 12 because I paid $300 for my premium, right? So what you need to do is say, what takes out of this 300. So basically you can just divide it, or you can multiply it, however you want to do the math to figure out however you want to do it. I normally just go ahead and just divide by 12. So I would do calculator 300 divided by 12, 25, right? Oh wait, that ain't right. Hold up. I need to get you the equation. So this is your purchase price. You divide this by 12, right? So now you're going to divide that. Am I doing this right? I feel like I'm tripping. Am I tripping? And that's going to give you your purchase price, I believe. I feel like I did the math right. I just feel like I'm just all over the place right now. So excuse me. I apologize. Because we have 300 shares, right? That's what it is. I keep missing the 300 shares. I'm sorry. That's the issue. I keep missing the 300 shares. All right. In my equation. So you're going to need, so this is how much you would spend, right? So that's what I was doing. I was forgetting this 300. So if you were to exercise your contract at $12, it would be $12 times 300 plus your commission, right? So this is what I was missing. That would be 3,600 plus the 339, right? So normally, if you were just to purchase 1,200 or 12 contracts in the beginning, right? So if you do 12 times, if you do 12 times, I was used to purchase 300 contracts or 300 shares in the beginning, you would spend 36. But since you have this extra 300, you need to figure out how many shares you need to cover your premium, which would just be one extra price up. So really what you need is the stock price to be 13, right? Instead of 12 or anything greater then $12.99, and you'd be at least break even. And the reason why is because we're covering this 300 here. So if you do 13 times 300, you're gonna get the 39, which is this number here. So if you're in your contract, and you can buy at 12, but the stock price is currently at 13 or higher than 13, I would exercise my contract, because I'm gonna make money on the long run by exercising my contract. Now, if your contract is worth more, right? So let's say your contract is now worth, instead of $10, is worth $20. Then you made $600. You made $600 because it's doubled. So unless you have to like measure, you have to keep like adding this to this and figure out what's more expensive. Is it better to take the $600 from the premium, or am I going to make at least $600 from exercising my contract? That makes sense. I butchered that example, and I apologize. I did not have one ready for you. But I hope that kind of sort of maybe makes sense. If not, we'll do it again. I promise. It's all good. Did it make sense though? Because if it doesn't make sense, I could do something easier. 'Cause I feel like I struggled through that. Bet. Okay. Okay, so let's get into actually how I chart my actual stocks that I'm going to trade. And I'm going to show you SPY. I'll show you SPY. We'll chart up SPY, and we'll do a live chart maybe like Facebook and stuff like that. And so charting is basically what you're looking for is supply and demand zones. Supply and demand zones are basically, supply means that there are a lot of sellers, and buy and demand zone means there's a lot. Demand zone means that there are a lot of this demand. So there's a lot of people that want to buy, right? Supply zone means there's a big supply and it's probably going to tank. So you have supply and demand zones. Buy and sell zones pretty much is what we're trying to calculate, where we expect people to buy and where we expect people to sell. And charting out these particular locations is how a lot of people trade. So let's look at an hour chart of the SPY over the last let's just do from mid-June to now. Actually pretty hard because SPY is pretty tough. Let's go a little closer and go let's do a 15-minute chart. And let's do a 15-minute chart. Okay. So basically what I'm looking for when I chart is where is the volume in the selling and where is the volume in the buying. And buying is dictated by, of course, a green candle. Selling is dictated, of course, by a red candle. And it's that simple. How can I chart where people are buying and where people are selling at? And what you're going to look for is common patterns. So like right here is a buy zone. So buy, once you get past a buy zone, it then becomes a sell zone. So that's what people mean when they say support becomes resistance and resistance becomes support. So I'm going to mark this line here. And then I am going to then more than likely mark this line here. And I'll explain everything in a moment. Mark this line. And then this line. And this line. All right. So we just charted all of our buy and sell zones. It's that simple and that fast. Okay. So we can extend this to the left, extend this to the left, and we'll explain everything as we go through the chart. Okay. So supply and demand zones. Where's their supply? Where's their demand? Where there are people selling, where there are people buying. And now my next level is normally at all-time highs. And on most of my charts, I normally have it marked by a big orange arrow to let me know, like, hey, bro, you're hitting all-time highs. It's scary up here. You might want to get out or just see what happens, because all-time highs are normally where a lot of people sell. Okay. So here we go. We're marking our zone. So let's go over the first zone up here. This is when the market was doing well and we were bouncing back. We were at 28, 27 or something on the Dow, and the market was very strong and people thought coronavirus was over, right? What you'll see here is a pattern, right? It's getting down to 319, and you'll see that it's a lot of people who are buying down here, right? And then it gets all the way up here. We have this really strong push. If you look at this candle here, if you look at this volume here, this makes it a lot better, right? You can actually see how the difference in the volume. So normally we're at about a mil. This is 8. That's how much volume was on this candle. So if you get down here, you'll see, all right, big candle here, a little bit of volume selling, a little bit of volume selling. So there's a lot of people selling right here in the mid, and a lot of people sell in the mid zones because you don't really know what's going to happen. I don't know if it's going to go up. I don't know if it's going to go down. So what people do is they take it back down to that buy level. We kind of get close, but not really. We're in 319, but 319.60, 319.62, which seems to be actually a better level. So let's move this up to here. This seems to be a better buy. Yeah, that's a better level right there. Yeah, that's a way better level. So you see, boom, it gets off of this. Boom, it comes down on a red candle, sells, bounces off of this. Really, really strong volume coming out of pre-market, right? Because people are slapping that as they're buying. Ooh, that didn't sound good. It's ask. Hold on, let me ASK. All right, ASK, not the other one. I didn't realize how that sounded. So they're slapping the ask and the bid. Or this is a price war, and you see people start to sell off, and it kind of gets down here, but people start buying back. They're buying back. They're buying back, and then look what happens. We get close to all-time highs, and this is actually the real mark right here. We hit all-time highs. And look at the volume. This volume was what was needed, literally, to go from 322 all the way up to 323. We needed 8 million on volume to touch all-time highs for this 5 or 15-minute green candle. Most 15-minute green candles you'll see can travel $2 or $3 off of just 2 million volume, but this one needed 8 million just to travel $1. That means that a lot of people are buying and selling in this 5 minutes the closer we get to all-time highs. That normally signifies that we're probably going to have a sell-off, because there aren't going to be enough buyers. If it takes 8 million to 10 million, or like 4 times your normal average to get $1, there's probably signifying that a lot of people are selling. Even though it's green, right? It's not as strong as some of these other green candles are. Like this is a $1.50 green candle at 6 million, so 3 million less. This is a $2 green candle on half, like literally half. This is a $1 candle on 8 million. So that signifies that buyers and sellers are battling, and eventually there's probably gonna be a pullback. And what do we see? We end up seeing a pullback the next day all the way back down to 319. So we hit all-time highs at 323, and we go all the way back down to 319. Right? So we're down at 319, and then what do we do for the rest of the week? 319, come back up pre-market, hit all-time highs, pretty much bounce back down. Boom, we come back down. We go a little bit under. We go a little bit under here, but that's your first sign. And how do we know that it was going to dip? Look how many times it could not pass all-time highs. So if we look at this volume, 8 million. Look at this. This is another 8 million. This is another 8 million. Every time we got close to all-time highs, the volume told us that a lot of people were selling. Every single time, whether it was in pre-market or whether it was during the market, people were selling off at 323. That's just what they did with heavy, heavy volume every time, right? So eventually, we're going to run out of buyers down here in this demand zone. we're going to run out of these buyers because they've been defending this and there's no more people to buy here. So now, since there's so many people selling up here, right? We don't have any more buyers here. We're going to dip. We're just going to dip. That's just how it works. So we end up what? Letting those people get out that bought down here. They get out and then there's no one else to buy because we've tripled, doubled, triple top. And now what happens? It just falls. It just falls down because literally there's no one to buy at this level. This is the next key level, but we passed that before pre-market even open. So we pass a whole level before the next day. And that's mainly because of the second wave. So you'll see that it literally just tanks all the way down to the next support level. It blows through everything. And what happens? Boom, we hit. We go back through another level. Boom, we hit that same level again. We try to go back through another level. And then what happens? We tank. We would have continued to tank today. But guess what happened? We got news. We got really good news that the feds were going to buy bonds. And that's the only reason it went back up. But these two tops right here. So this one is the reason why we dipped in the morning. Because there were no more people to defend this. That's just how it works. You can tell when it's going to bounce. This is how we know when things are going to bounce and when things are going to fall. When we run out of buyers in a zone, it has to go to the next zone. It just does. That's just how it works. Supply and demand. And that's how you chart. I chart based off volume and I chart based off of support. Right? So volume tells me where people are selling at and volume tells me where people are buying at. So I can look at these candles down here. Look at these red candles. They're big red candles, but they also have a lot of volume and they're defending this line. So even though it's red, it's buying and selling here because if it was all selling, it would dip, right? If it was all selling, it would dip. This is buying and selling on this line. And if we looked at a 5-minute chart, it'd probably look a little different. Let's see if we can look at a 5-minute. Right. If you look at a 5-minute chart, look at the green candles now. These people are just buying down here because they're defending this line. There's a lot of buyers at 300, period. That's just what it is. There's a buyer at 300 here. There's buyers at 300 over here. Down here. There's still buyers at 300 here. Even though it gets down a little bit more, it's still buyers here. And then we get, once we break it, once there's no more buyers, what do? We dip. And we go down to the next support level. But when we get good news just trumps everything. We took off today. We made a lot of money. That's how you chart. That's the basics of charting supply and demand zones. And we can do that for every chart, right? So if we go to Facebook, we do the same thing for Facebook. First we're going to mark our all-time highs. So we at least know where we are as far as all-time highs. We have all-time high here. We have a supply or demand area here. Looks like we have another one here. And I wouldn't necessarily say here. This one's a little tough. Facebook had a really rough week. So it's really hard to chart this one. But I would say here. And then probably looks like consolidation here. All right, so now that we mark them, we can then go in and check volume. We can dig down and check the volume. So it's to the left, left, left. All right. So if we look, we blew through these zones. Look how strong we blew through these zones. If we blow through 3 zones, I normally expect a pullback. That's just normally how I just expect it to slow down. Facebook is weird. It kind of does what it wants to do. Sorry, I was looking at a post in the group. So you'll see supply becomes demand becomes supply, right? So support becomes resistance becomes support. So I know this is the proper line because look at this. Look at this volume on this green candle. It's literally the highest, about a million shares in an hour, or 5 minutes. A million shares in 5 minutes. It got up to this line and it just couldn't take it out. There wasn't enough buyers at that line or at that level to take out that resistance. So it faded. It fades back down. It fades back down. But people probably was like, okay, we're tripping. And they started buying again. And they eventually pushed through. They eventually pushed through that line. But it wasn't strong enough. It wasn't a strong push through. And it fades back down. So if you look at resistance here, where does it fade back down to? It fades back down to where it was originally resisted at. Originally, we were at 237. It resisted it. It fell back down. It made a weak push through. Like, these candles are very weak. Even though it goes above it, it doesn't have enough buyers to maintain the run. It goes right back down to where it was originally resisted at. Okay. And I'm sure it probably played that for the rest of the week. It does. Boom. It goes up, goes down. Boom. Boom. Right. Boom. Again, it has people here. It tries to bounce off of it. Right. You see, it tries to bounce off. It's just not enough people. It fades. People start buying back. It fades here. It fades. It tries to bounce back. It couldn't hold it. It tries to get back up there. It's trying. It cannot hold it. It just can't hold it. And then it just fades back down. You go into a recession line. This should tell you all you need to know. So this selling here is literally just orders being filled. It's just orders being filled. People thinking they're being smart and they're going to be able to get out. But these candles aren't strong enough to get through a resistance line. It's not enough buying. It's just not enough. None of these candles are enough buying to overcome the selling that's about to happen. That's how you read volume and support and resistance. And that's it, guys. I think that's all I'm going to do for tonight. I'm going to keep it shorter than normal. Any questions before we get out? I always appreciate you guys coming by. Any questions before we go? All right, I don't see any questions, so I appreciate you guys for coming by. I appreciate you guys hanging out with me. Good luck trading tomorrow. Again, I'm not a financial advisor. Trade at your own risk. Do what you feel like is best for yourself and your portfolio and your future. Make sure you follow the YouTube channel, Breaking Stereos. We're going to start putting out smaller videos. I just have to figure out how to do them. They're actually really tough. I thought they were going to be easy. They're actually really tough to do. So appreciate everybody for coming out. Hold up, is this a question? Oh, I thought I had a question. I appreciate everybody for coming. Thank you. We're going to do this as often as possible. All right, guys. Take care. It's been love, peace, and happiness. Take care.